Good morning and welcome to the Bp Marsh and Partners PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question, press send. The company may not be in a position to answer every question it receives during the meeting itself, but the company review all questions submitted today and publish responses where appropriate to do so. These will be available via our Investor Meet Company dashboard. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Brian Marsh, Chairman, Alice Falk, Managing Director, Sinead O'Hare, CLO, and John Newman, CFO. Good morning.
Good morning.
Good morning, everyone. So I'm John Newman, the Group Finance Director, and I will be going through the presentation of our full year results to 31st of January 2022 this morning. I'd like to thank everyone for attending. I know some of you may be watching this recorded after the event. Unfortunately, Dan Topping, our Chief Investment Officer, is unwell and unable to join us today, so I'll be running through his part of the presentation this morning. Turning to slide 2, this is a standard legal disclaimer that sets out about distribution and forward-looking statements. I'm sure you've seen many of these many times before. So slide 3, a brief synopsis of Bp Marsh, who we are, what we do. We're a specialist private equity investor in early stage financial service businesses in minority stakes. We're based in the UK, but we invest both UK and internationally. We've got a highly experienced team with a strong background and focus on insurance intermediaries specifically. We were founded in 1990, floated in 2006. We've invested in a total of 54 companies and currently have 15 in the portfolio. We take a medium to long-term view with an average holding period at the moment of just over 7 years. And typically we invest anything up to 5 million, although generally that's probably closer to 1 to 2 million and follow-on funding. On to the following slide. This just sets out our PLC board. As you can see, we have a wealth of experience with an average of over 30 years experience in financial services, investing in buying, growing and realizing investments, and the executive team themselves have all worked together for over 10 years. The following slide, this sets out our track record for net asset value growth since flotation. I think the key message here is, as you can see, we've shown a consistent level of growth over the years, despite wider macroeconomic issues at various times along the way. And we're currently at 166.6 million. The following slide 6. This slide shows our long-term share price performance, which overall has been very good. However, we are frustrated by the current discount to NAV, and I know there were a couple of pre-submitted questions regarding that, and we will deal with that later on in the presentation in the Q&A. I'll be running through the finances in a bit more detail later, but the headline figures are: we've grown the NAV from just under 150 million from the preceding year to 166.6 million. That equated to a total shareholder return of 11.7%, including the dividend just under 0.9 million paid in July 21. And we've declared a dividend of 2.78 pence per share to be paid in July of this year. The following slide sets out our dividends and our policy in more detail. Essentially, we are a capital growth play, but we do recognise the importance of dividends, and traditionally we've made distributions after key realisations, such as notably after the sales of Hyperion in 2013 and Besso in 2017. And in both those instances, we agreed to a 3-year dividend distribution policy. We have, as I've said, declared a dividend 2.78 pence per share, which is up just under 14% from the preceding year. But we also aim to maintain that level of dividend for the next 2 years. So in aggregate, that represents at 3 million, almost 100% of the realised underlying profit, excluding unrealised gains for the year to 31st of January 2022. It's also worth noting that the group does accept that if we have further successful realisations, the board will revisit and reconsider the level of distributions for the following 2 years. Since flotation, we've distributed a total of 10.6 million, which is equivalent to just under 33 pence per share. We see a number of opportunities for continued growth in both the existing portfolio and in new business to continue to grow the NAV, and therefore we aim to strike a balance between rewarding our shareholders with distributions when we have key realizations and reinvesting cash to continue to deliver long-term net asset value growth. The following slide sets out our investment model. We're aware that a number of people watching this might be new to the business, and so therefore we thought we might go into a bit more detail than we would usually do on our model and process. As we said, we are a specialist financial service investor in minority positions, typically between 20 to 40% holdings. Very few other private equity firms take stakes in this size, especially up to 5 million level. We also provide follow-on funding for growth. That would normally be working capital for new hires or acquisition financing. Within this sector, there is what's known as a financing gap that we often see, because a lot of these sort of smaller stage businesses often find it difficult to get financing, and certainly financing where there is some element of expertise around what they are and what they're doing, and they require assistance. So apart from occasional sort of crowdfunding or friends and family angel investing, bank finance usually isn't suitable because they want guarantees on property, and so we see ourselves as filling that gap, and there's a following slide on that. But the key thing in our investment model is we invest in people. These are people businesses, they're not asset businesses, and so therefore we focus on backing entrepreneurs and management teams with excellent track records of delivering growth. We have a clear focus, therefore, on working alongside these people, and that's one of the defining aspects of our investment process. So the following slide sets out in a bit more detail about what we call bridging the gap. So typically, we invest from startup to enterprise values of around 25 million, and we tend to find that most small to mid-cap funds don't get involved unless the valuation is double that, and so that gives us a unique opportunity. At this level, we can be flexible with valuation multiples. They're usually significantly lower, and that enables us to build up the value of the business, both in terms of growing business, growing revenue, growing profit, but also in growing the multiples as well, as we have set out from our realizations. We're flexible in the way that we approach every investment opportunity, and we get to a stage where trade sale or we grow these businesses to a stage where the small to mid-cap funds and larger private equity firms take a level of interest. Following slide sets out our investment opportunities. So in the year to 31st of January, we had 48 opportunities. I think it's fair to say over the last couple of years with COVID, there was a strong focus on the existing portfolio, where we are seeing an uptick in investment opportunities. As set out here, 38% of those emanated from our existing network and referrals, 44% overseas. As you can see from the chart, the vast majority were in insurance intermediaries. Although Dan's not here to provide specific detail on some of the opportunities that he's looking at, we are looking at several at the moment, specifically within insurance broking, and I think Dan's was quoted as saying he's expecting us to do another sort of 1 to 2 deals for the remainder of this financial year. In March 2022, we did make an investment in a startup. We acquired 40% in Denison & Partners, which is a London-based Lloyd's insurance broker, which focuses on UK and North American reinsurance solutions in financial and professional lines. We've given a few examples of where some of our previous investments have come from by our network or through referrals from advisory firms. Slide 11 sets out our investment approach. So what differentiates us between other investment houses? We think sort of 3 key areas. Our flexibility, so that's in terms of our ownership stake, and we say sort of typically 20 to 40%. Kentro, which has been rebranded originally Nexus, that's a good example where we originally went in for 5% shareholding, 1.5 million, and have grown that to a holding of over 19%. I'll go into Kentro in a bit more detail later on. Also flexible regarding follow-on funding and timing. We take a long-term view. We're not restricted by set exit clauses. We therefore don't have to work to rigid sort of typical 3 to 5 year exit plans, and therefore work alongside management to achieve exits that are mutually beneficial. Prime example being Ssiu, where we were invested for 21 years and still delivered a IRR over that entire time of just under 22%. I think it's worth pointing out with some of our longest holdings of Ssiu and Hyperion, which was about 18, 19 years, there were opportunities to exit along the way. It wasn't that we were tied in for that length of time. We typically see opportunities every few years, but we stayed with them because we continue to see growth and we continue to play an important part in their growth. Another important dimension is the value add. So we bring more than just plain finance. We have expertise across the board and within the company. We provide board level representation, ongoing support from them. That can be from a strategic, financial, legal. We provide referral. We often get through new business opportunities where things aren't quite for us, but they might suit some of our investee companies. We can provide referrals, and we've got lots of contacts within the network. Following slide sets out our process from investment through to realization. Just a bit of detail. So once an opportunity is received, it's scrutinized by our new business department, which is headed up by Dan. That will then be championed, who will then run that process all the way through in project management through to approval at our investment committee level and ultimately PLC board. So we will meet with the teams, we will go through the business plan, we will interrogate it, and if we consider that it's an opportunity, we will formulate an offer letter. And once we get that approved, we then go into the formal due diligence stage, and we will conduct financial, legal, commercial DD. Most of the time that is conducted by external parties, and then completion. The completion is just the start, really. After that, we want to make sure the business plan is implemented, although we are flexible and we change with the, how the markets are changing, and we take on opportunities. We put an NED on the board, have regular communications, although we take what we consider an eyes-on, hands-off approach, where the day-to-day management control is of the business is with management, but we provide strategic support. We also have a number of specific restrictions within the shareholders agreement in relation to anything that could potentially denude valuation, which requires our approval. But those are for things that are more sort of strategic, as in acquisitions, disposals, that kind of thing. We can also provide administrative secretarial support. We have, other example, I was seconded for a while to one of our investee companies for financial support. We're quite often with startups. They tend to be producers, underwriters who want to grow a business and a book, but might not have experience of actually running a business and doing the administrative back office. Sinead will help with her team on the legal and COSEC side of things. So we provide more than just the money. An exit. Well, importantly, we look at exits right from the start. Who we think this is probably best suited to. We look at the kind of multiples we think that we're going to return, and we target things that are, sort of ultimately going to achieve 25-30% IRRs. We have some that achieve way in excess of that. Some not there, but obviously our long-term track record speaks for itself. We will obviously, through the strategy, we've got contacts, and we will advise on which investment partners to take on, who might be the best fit, and we see that through all the way to eventual exit. So the following slide sets out our portfolio, starting with the MGAs. Our total equity portfolio was 149.3 million at 31st of Jan, which was up 14.7% over the year. This slide sets out the MGAs, which constitute 62% by value of our net asset value. Our MGAs, on a gross basis, are budgeting to underwrite premiums of over 760 million this year, which should produce 74 million of commission income and EBITDA of 23 million for those businesses. The MGAs, these write on behalf of insurance companies using their capacity, but it is worth highlighting for those who don't know us too well, that we don't invest directly in insurers, and therefore we aren't exposed to primary risk on insurance losses. As you can see, our MGAs have performed exceptionally well since investment, with a current value of over 3.1 times the investment cost, 103.3 million. Notable within the year, Kentro was up 6.6 million, adjusting for the new equity investment. XPT, our American MGA, up 5.8 million. Ssiu, Toronto-based, up 2.5 million. Agard, our Australian agricultural MGA, up 2.1 million. So I think it's worth noting that the smaller investments are showing considerable growth. It's not just the large ones. I'll deal with Kentro and Ssiu in a bit more detail later. Following slide 14 sets out our broking investments, which constitute about 13% of our current portfolio NAV by value. Whilst it looks a lot lower at 1.3 times investment return, historically since inception, a lot of our growth has been from a track record of successful investment in Lloyd's and London market insurance broking, as well as internationally. Our broking investments are budgeting to place more over 700 million of GWP this year, which will produce more than 59 million of brokerage and more than 15 million of EBITDA. The majority of our broking investments are relatively recent, having completed in the past 5 years. I think it's worth saying that those are seeing the benefit of a period of continued premium rate increases, and we are seeing a lot of growth and development on that, and so they remain an important part of our portfolio. The following slide just sort of summarizes the point on both the brokers and the MGAs, with about just under 1.5 billion of premiums managed, split almost 50-50 between the MGAs and brokers. On to slide 16, our largest investment, Kentro, which has been a rebrand, formerly Nexus Underwriting. Nexus is a specialist MGA. It's based in London, but has 16 offices across 9 countries. Key areas it writes is D&O, PI, financial institutions, trade credit, and it also has Xenia, which is its trade credit broking arm, which is one of the largest independent UK trade credit brokers. Kentro, we originally invested 1.5 million for a 5% shareholding back in 2014, and we've subsequently invested up to a total of 15.1 million that is now valued at 51.5 million for over a 19% shareholding. So that's a total IRR based on valuation of over 30% since investment. Key developments with Nexus during the year, Kentro I should refer to it now as, is it refinanced with Barings and secured 70 million of financing, of which 50 million was term debt and 20 million available for new acquisitions. As part of that, they repaid a £4 million loan to Bp Marsh. We then used that to increase our shareholding. You see our shareholding went up from 17.5% to over 19%. Kentro, obviously significant growth, 55 million premium when we initially invested, and it's estimating almost 450 million in the current year. It's made 23 acquisitions and continues to source many acquisitions as part of its growth strategy going forwards. Following slide, SSRU. This is an example of our sort of niche and flexible approach to investing. SSRU is a Toronto-based specialist casualty underwriting agency in the sectors mainly of construction, manufacturing, and energy. This was a startup investment, is now writing over 70 million Canadian dollars of premium budgeted for this year, delivered 4.6 million Canadian dollars of EBITDA in 2021, which is incredible growth for such a small business. Highly leveraged deal, £19 of equity investment. We provided loans, all the loans have been repaid, and so we're currently looking at an 8.1 million equity valuation. I think this is sort of an example of the type of investment that Bp Marsh specialise in, and where we're attractive for external investors to us. These are sort of small niche, but with excellent growth potential, and shows that it's not just the Kentros of the world that are delivering excellent growth in the portfolio. Following slide, CBC, we assisted in an MBO about 5 years ago. This was a business that was barely breaking even. We backed management, and it delivered 2.2 million of EBITDA last year, up 33% on the year. CBC are a London-based retail and wholesale loans insurance broker. Another example of a leveraged deal, we provided 5.1 million in loans, notably during the year. Based upon their excellent performance, they refinanced 3 million with Coots, and that led to 2 million of our loan being repaid during the year. They're continuing to grow strongly, having taken on a number of people and a number of teams, and our equity is now valued at 9.4 million from a total equity of 0.8 million. The following slide, EC3. Whilst we've had excellent successes, there are occasional disappointments, I suppose, and we're not immune to potential difficulties in the wider markets. Unfortunately, EC3 was significantly adversely affected by the COVID-19 pandemic. Their contingency division, which was a large proportion of their revenue, which was providing event cancellation insurance, effectively dried up overnight at the start of COVID-19. And then once the market started to open up again, unfortunately, the division left to join a rival broker. We did assist with EC3 in securing a large settlement for that. But as a result, with a significant reduction in overall revenue, we have reduced our valuation in EC3 significantly. Whilst this is clearly disappointing, we have continued to provide ongoing support to EC3, and we consider our long-term and flexible approach enables opportunities. We've had ups and downs with some of our best and highest successes in the past, and so therefore, whilst it's disappointing, I suppose looking at it from the black and white, there's a lot of upside potential versus downside risk at this point in time based on the valuation, and we are aware that they are starting to achieve traction on a number of new business initiatives, and EC3 consider that their prospects growing for the future. The following slide, we have one non-insurance intermediary, which is Lebc Holdings, which is an IFA. And whilst this might look unusual within the portfolio, we have had a track record of successfully investing in typical businesses like this before. We had an investment in Thompson Group, which we sold to AWD for a very good return back in the early 2000s, and Principal, which was a discretionary fund manager that we sold to Sanlam in the mid-2000s. Lebc has gone through a restructuring, but delivered 3.2 million pre-exceptional EBITDA last year, and continues to grow EBITDA for the current year, which is an excellent return to form. As you may be aware, unfortunately, founder and key shareholder Jack McVitie passed away But in January, Tavistock Investments acquired their stake for 10 million, which underpins our valuation of 25 million for our 59% holding. I think it's worth noting that although we say we're typically a minority investor, we didn't seek from the outset a majority holding in LEBC. That came around as a result of one of the founders retiring, and we were asked if we could take on that holding to enable them to remain independent. So that was one that was sort of more opportunistic, but it's quite unique. We've had a number of successful realizations during the year, and the next slides set them out. I won't go into too much detail on this because I'm sure you've seen it all in the RNS announcements. But MB, which is a high value motor MGA, was sold into ATC, which is another MGA Australian that we hold. And our original investment in MB of $500,000 in equity was effectively rolled up into new shares at a value of 3.6 million. So we consequently increased our holding in ATC from 20% to 25.6%. But overall, that delivered a 29% IRR or 9 times multiple of equity invested. So that was a excellent return there. Following slide, Walsingham. This was a London-based MGA in taxi and courier fleets. Original equity investment of 0.6 million. We sold for 4.9 million. I think it's worth noting that we valued that at 2.3 million at 31st of January. So that was an excellent return based upon our last valuation, and delivered an overall IRR of 22%. And a money multiple of 8 times. Finally, on the realizations, agreed during the year but completed just after, we sold a majority holding that we had in Ssiu to Acrisure. That completed in March, was 8.1 million of equity versus an original 6.1 million cost. I think it's Dan's quoted at the bottom of this saying, in isolation, whilst that return of 5.5% IRR might be below portfolio expectations, I think given where Ssiu were, I think a number of our investors and analysts have possibly queried how long it might take us to be able to realise that investment, thinking that we might be in there for another 3 or 4 years, and specifically might need to provide further funding to it. It was a consolidator of regional insurance brokers in Spain, and I think what we've managed to achieve there is an excellent cash return and replenish the liquidity for the business. And we wish management all the best in the future with Acrisure. Following slide just deals with a brief overview of the market. Clearly, we consider that the portfolio companies have performed very well for the year. We've made a number of successful realizations at or above valuation. We now have significant increase in liquidity from, we were at 0.7 million in cash last year with 1 million of borrowings, and we're now, we're 17.5 million, but we've just conducted a follow-on investment in XPT. So we've got 14.7 million now. So we've got availability to pay dividend and for investing in new opportunities and the existing portfolio. As discussed, we've made a new investment in Denison and Partners and continue to see other interesting opportunities. There's been significant consolidation within the insurance market, and we consider to see opportunities from that in terms of individuals and teams who want to see that as an opportunity to start off on their own. And that gives us excellent advantages and opportunities going forward, both within new and existing businesses. So as Dan's commented here, whilst there's some signs that rate increases are slowing, it doesn't seem that price increases will continue throughout 2022, which will continue to benefit our portfolio. We clearly continue to monitor the possible effects that the conflict in Ukraine have on the insurance market, although at this point in time, the effects of the conflict are particularly minimal across our portfolio specifically. I think the largest area, as Brian alluded to in the chairman's report and statement, was the fact that inflation may well bring its own pressures on FX and things like that. But our overall view is that we expect that the gains that we make in within the portfolio will outstrip any potential detriment on that side. Following slides set out our key financial highlights. Overall, NAV increased by 16.7 million, or 11.1% for the year, to 166.6 million. And that equates, as I said earlier, to a total shareholder return of 11.7%, including the dividend of 0.9 million paid in July 2021. Overall, the group delivered consolidated profit before tax of 19.4 million, up 5.7 million over the prior year. The majority of that profit relates to the increase in valuations of the investments. It's covered earlier, with the equity portfolio rising by 14.7%. One of our core strategies is to ensure that the yield from our portfolio covers our operating expenses, so that we aren't depleting our investment cash for working capital. On an underlying basis, it was pleasing to see the profit was 3.2 million, up from 0.9 million the previous year, although the uplift over the year was in relation to the successful realizations that were realized above our previous valuations. A final dividend of 2.78 pence per share, or 1 million, has been declared to be paid on the 29th of July, as to be approved at the AGM. That's an increase of 14% over the previous year, and as stated earlier, the intention is to maintain at least that level of dividend for the next 2 years and review based upon further following successful realizations. Overall, since flotation, the group has delivered average compound NAV growth of 8.4% and 11.6% since inception. That's after all expenses, tax and distributions, and excluding any capital raised on the markets. So this slide sets out the key financial investments, realizations and loan portfolio movements during the year. As discussed, we've invested 8 million in equity during the year, 4 million new shares in Kentro, rolled up 3.6 million of our value in MB into ATC shares, and we also acquired some further shares in Paladin from an exiting shareholder. We also delivered 8.8 million in equity proceeds, 4.9 million from Walsingham, 3.6 million from MB, and we sold some shares to Paladin that were under an option that they cancelled. They bought back and cancelled. And obviously post year end, we've had the summer disposal as well. Loan portfolio. So I think it's worth just covering a little bit on that. Given we don't set exit clauses and are a medium to long term investor, we do often structure our deals with a mixture of debt and equity, although never just debt. That enables a yield to be received on the investments to cover our operating costs, and the loan repayments help to replenish our capital funds rather than having all of our capital funds tied up over the period of investment. I can confirm all of the current loan book as listed are up to date with both capital and interest repayments despite the pandemic, and all the loans are valued at par. So the loan portfolio at 31st January 2022 stood at 10.4 million, had come down significantly from 17.1 million the previous year. We had 7.8 million total repayments, 4 million repaid from Kentro, that, as I said, we reinvested in new shares, 2 million from Paladin, which is the holding company for CBC when they refinanced with Coutts, and we also had 1.1 million from Mark Edward Partners when we parted company with them, and that was fully provided against, so was a 1.1 million effective net uplift. So we delivered 8.6 million in cash at the year end, up from 0.7 million the previous year, and we've repaid our loan, and the 3 million loan facility that we had in place ceased in January, and now we've got plenty of cash in the bank. 17.5 million, as we reported our final results, the $2.8 million, $3.5 million investment in XPT has now completed, and so we've currently got 14.7 million, though we're slightly ahead of that at this point in time. We have a current discount to NAV of 31%, which we consider, based upon the current share price, is unwarranted, based upon our track record and NAV growth. So turning to summarise, so why invest in Bp Marsh? We're a leading specialist investor with an excellent track record and a team with a wealth of experience. Although we specialise in financial service businesses with a specific interest in insurance intermediaries, our portfolio is diversified both in product lines and geographically, which mitigates the risk. In the insurance intermediary space, based upon where the market is and consolidation and where multiples are going, continues to offer excellent returns to savvy investors. Reiterate, we've achieved an 8.4% compound growth since flotation, 11.6% since inception after all expenses and realizations, through identifying, growing opportunities and delivering value and return to shareholders, as demonstrated by growing the NAV to 166.6 million, despite challenges on macroeconomic basis we've faced over the last few years. Our liquidity is now strong, having increased it up to net 14.7 million. We continue to see excellent opportunities in new investments and follow on, as evidenced by our recent follow-on investment in XPT. As we say, we consider the current discount to NAV of 31% to be unwarranted. So this concludes our formal presentation. I'll now hand it back over to Paul on IMC, and then we will deal with Q&A.
Fantastic, John. Thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those questions submitted already, I'd like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. I'd now like to hand you over to Tim Pearson to pose your questions to the Bp Marsh and Partners team where appropriate to do so.
Thank you, Paul. So we had some pre-submitted questions to start with. The first question is, Brian Marsh has led this company with great success for many years. Every business has to deal with succession. So given his age and roughly 40% shareholding, I'd appreciate hearing any comments he has to make on the issue of succession planning. Brian, I'll hand that one over to you.
Right. Well, regarding the matter of succession planning, my colleagues here on the board and I continually monitor succession planning in all areas of the business, not just in the chairman's office. And we remain confident that the current management team will be able to lead the company effectively when the time comes. When the time of my departure comes, there will be a slight slotting up of everybody. Alice, as managing director, will either handle my affairs entirely, or she might appoint, for example, a non-executive director, a non-executive chairman to take over above her. Maybe one of the NEDs might well take on that position. John looks after the finances anyway, Daniel the business itself, and I think that there is every reason to believe that we've had succession planning addressed right from the beginning.
Thank you. We've had a couple of questions on this. I'll ask one of them. Hopefully this should summarise the three questions we've had on this. Given the discount at which BPM's shares trade relative to the NAV of the underlying assets, why has the company not pursued share buybacks? Will it do so in the next financial year?
Sinead, do you want to deal with that?
I will, yes. So
Sinead is our Chief Financial Officer, and she will address that topic.
So yes, we've had quite a few questions about share buybacks, so I'll answer them all together and do my best to do so. We've announced previously that the combined shareholding of the chairman and his concert party is roughly around 42%, which activates the City Code on takeovers and mergers, and therefore share buybacks will result in increased shareholding of the chairman and his concert party and trigger a requirement for a mandatory offer to be made in accordance with Rule 9 of this code. We have investigated opportunities and ways around invoking this, which would require a whitewash approval. And over the past 3 years, we've reviewed how we would go about that and the costs in doing so. And after investigating this thoroughly, we as a board decided that that was not the best use of funds, and instead those would be better used, put towards payment of a dividend, which is something that the board knows is a priority for the majority of its shareholders. However, that being said, this is regularly reviewed, and therefore it's quite likely that this approach may be amended or changed in the future, but it will just depend on the situation at the time.
Thanks, Sinead. Another question. The company's done a great job of building value over the past decade, but this is not reflected in the share price. What is management planning to do to reduce the gap between the share price and NAV? Would it consider special dividends over buybacks, as Mr. Marsh's large holding prevents large repurchases? Sinead, I think
Let me deal with that one. I think we're probably there's a number of points on this in terms of reducing the NAV. I think it's fair to say that the markets in general are affecting share prices, so it's not unique to Bp Marsh. We're probably about 10% down as a factor of what's going on in Ukraine and the wider macroeconomic factor, despite the fact that we continue to deliver strong results. So I think from our perspective, that aside, our focus is to continue to develop the portfolio, to grow the NAV, deliver successful realizations as we have at or above past valuations, continue to engage with investors and new investors. This is an example of where we are providing further update to the market, plenty of news flow, dividends. We've mentioned, we'll continue to consider them based upon realizations, and I think as a whole, they should get that. We have managed to get the discount down to about 12%, although it's probably nearer about 15% at one stage, and I think that's what we will hope to achieve just by continuing to do what we do best, really. And as we continue to do that and get more interest from shareholders who want to follow in that path and see the value there.
Thanks, John. Another question, which I think is slightly covered in the presentation. Can you comment on the write-down in the value of the investment in EC3 brokers?
Yeah, I think we covered that off on slide 19 of the presentation. It's available on there again, but it was specifically to do with COVID-19 and a reduction in a sizable part of their business revenue.
I mean, if you were to see it from the past, you'll see that we've always written down any of our investments where we're a bit nervous, and usually we overdo it, and therefore we are able to climb up a year or two later. But it's a jolly good idea to be cautious rather than not.
Thank you, Brian. Further question on dividend policy. Can you make a comment on dividend policy? The latest payment is below that in 2017-18. Is the dividend a function of the quantum of disposals? Again, I think we touched on this in the presentation, but any?
Yeah, I think we covered that off in slide 7. I think that is fair. As we said before, we have historically declared dividends out of successful realizations. We've done the same. We've declared a £1 million dividend, although and with an intention to maintain that for the next 2 years, and we will revisit that following further successful realizations.
Thank you, John. A question question that's come in regarding how often are you in a competitive process with other bidders for investment opportunities? Or
we try not to be, is the answer to that. Our approach, this is Alice and I deal with these things ourselves. Our approach to that is if someone wants us to invest in their business and we wish to do so and we make an offer to do so, and they then pop up and say, oh, well, there's someone else over here who'll do better, we pull out. We're not interested in competing.
No,
I think.
sorry, you go.
Go on, Alice.
No, I mean, we're a people business, as you know, Tim, and ultimately we support people. And if they can see value in our investment, notwithstanding the fact that it might not be the cheapest or best terms, we offer over and above what the banks or other private equity businesses, in our view, do in terms of backing management and our flexible approach.
Our attitude is either they want to come in with us or they don't.
Yeah.
It's up to them.
And if they don't, then then that's
If they don't, they go somewhere else. That's fine.
I would say it's very rare, actually. I think focus back on where we said about bridging the gap. There are people who sort of in and out, but generally more generalist investors, and so therefore we tend to find with the people who want to come and get investment from Bp Marsh, they want it for a reason. So we don't tend to be involved in competitive processes.
No. Next question.
Thank you, John. Thank you, Brian. We're aware there's been a couple of other questions, but we will probably provide written responses to those just to make sure that we get the full detail after the presentation, which will be made available via IMC. So at this time, there are no further questions. Paul, shall I hand back to you?
That's fantastic indeed. Thank you very much indeed for answering those questions. As Tim said, the team will have the ability to review any further questions. We'll publish responses where appropriate to do so on the Investor Meet Company platform. Brian, if I may, just before redirecting investors to provide you with their feedback, which I know will be important to you and the team, if I could just ask you for a few closing comments, please.
Well, my only closing comments, I think, probably would be that I hope you've enjoyed listening to us and we've enjoyed the opportunity to present to you. We say what we can, we do what we can, and we haven't done badly, you might agree.
very good.
Fantastic. Thank you indeed, Brian. Thank you indeed to the whole team for updating investors today. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to do and is greatly valued by the company. On behalf of the management team of Bp Marsh and Partners PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Good morning.
Thank you.
Thank you, everyone.
So